Hello, everyone. Thank you very much for joining. This is Ankur from MarketXLS. We'll give it a few seconds to have a few more people join in, and then we get started. Okay, so welcome everyone. So we can get started now. Thank you very much for your time and joining this first webinar of MarketXLS. I was wondering if you could just type in your chat message that you can hear me. Yes, the session will be recorded and it will be available. I was wondering if you could just type yes or no if you could hear me in the chat message. Perfect. Thank you very much. Thank you all. Okay, so this is one of our first series to, over this, period of 5 years, we have worked with MarketXLS to improve the product, and over this period of time, many of you have come and asked us, how other people use the product, right? And so with that request in mind, we thought it would be a good idea for us to create a series of webinars where we will invite our customers to come and showcase how they use the product and what is their investment research workflow. This will not only give yourself an ability to see what other people are doing for their investment research and how they use MarketXLS. So as part of this series, we are calling more and more customers, and if you would like to be a customer who would like to present your use case, that will be great. Please send us an email at ankur@marketxls.com or support@marketxls.com, and we can work with you. Now, many users of our product use MarketXLS for various purposes, like starting to research on stocks, scanning, filtering on option contracts, and managing their portfolio, reporting on their portfolios, and doing their own models. And essentially, we will have various topics covered in these series of webinars. So today we have Katharine here with us. Katharine has been our customer for 5 years now, and she has given a lot of feedback. And many of you, if you are using MarketXLS, are already using some of the results of her feedback. So without further ado, I would like to introduce Katharine to you, and we'll take it from there. Katharine, over to you. Thank you very much.
Hi, everyone. Can you hear me okay? Ankur, am I getting a few yeses, I hope?
Yeah.
Okay. So thank you for joining the webinar. This is something new for me, and hopefully I will do a good job and you will learn something useful. I'm not going to spend much time on a PowerPoint. Most of our time will be spent looking at spreadsheets and at what MarketXLS can do. But I did want to give just a little bit of information about me and about how I invest, because as you probably know, there are hundreds of different strategies that a person could use to invest in or trade on the stock market. And I use 3 strategies, so I wanted to tell you just a little bit about those. But I retired 2 years ago from a long career as a hospital pharmacist. I saved a good bit of money. I knew a few years before retirement that I really wanted to be able to manage my own investments, but I didn't know anything about it. So about 3 years before retirement, I started to learn and spent a lot of time just trying to figure out how I would manage this when I did retire. I made a lot of mistakes. I eventually settled on being a value investor and an options trader. I'm more focused on creating an income stream than I'm worried about whether the price of the stock goes up or down. It's great when it goes up, but mostly I want an income. So to that end, I found myself asking a question: how can I get other people to give me cash? Somebody paid me a dividend and I got so excited. Somebody gave me $10, and can I keep doing that to the extent where I could live off of those cash deposits? And so how that has ended up happening for me is that I have 2/3 of my capital invested in good quality dividend paying stocks, and I'm able to monetize those assets, the stock that I own, two ways. One is that I collect the dividends that they pay, and the second strategy on those stocks is that I sell covered calls against a lot of the positions and earn option income from those premiums. The other 1/3 of my capital I keep in cash, and I use that to secure puts that I sell. I always try to sell puts on stocks that I would not mind owning because I may end up owning them. And the third strategy comes from that cash, and it's selling puts and collecting the option premium. So how do I do? And these are typical annualized returns from each of those income streams. On the dividends, I average between 4 and 6% yield on my cost from dividends. On the call premiums, it averages between 3.5% and 7%. And the puts, which are by far my favorites, those I average between a 20 and 25% yield on cost from the put premiums. And when I say yield on cost related to put premiums, that's referring to the amount of cash that I set aside to secure those puts. I do not ever use margin. I do not trade what they call naked options. I'm very conservative, and I only do cash secured puts and covered calls. Overall, I average about 11 to 15% return on my invested capital in the form of income that is basically just people giving me cash. It's wonderful. And I don't worry too much about stock prices. If they gain in value, that's great. If not, that's okay too, to some extent. I wanted to just tell you about my relationship with MarketXLS. I found them 5 years ago from a Google search. I asked some questions and bought the data plan. I have the plan that is not real-time data. It is Ankur, you might have to help me say what the name of the plan is.
The Pro Plus plan.
Okay, thank you. And the data is delayed by, I think, about 15 minutes, which is sufficient for my purposes, but they do offer a real-time data plan for those of you who need that. Over the years, I communicated with Ankur through emails. I would report a little problem or ask for something new to be added. And so we developed a relationship based on those emails. And then I recently have agreed to serve on the advisory board for MarketXLS. So when I look to buy a stock, I have certain criteria that I look for. I want it to pay a dividend, and I want that dividend to be safe. Some pay huge dividends, and some pay tiny little dividends that grow every year as the company raises them. So one of the ways I know that it's safe, or I can increase the odds of the dividend being safe, is that they have a good history of paying and increasing the dividend. And then I also look at the payout ratios. If they're paying out more in dividends than they're making in earnings, then that may not be a sustainable situation, and the dividend may be in danger of being cut. I'm also looking for good quality stocks, which I define, as you can see here on this slide. I am a value investor. The worst thing I can do is pay too much for a stock, so I look for cheap stocks or good stocks when they are cheap. Here lately, that's hard to do, but sometimes you find one. And then I try to diversify between sectors because I'm not the greatest stock picker in the world, so I just need to not have all my eggs in one basket. And diversifying helps. I think of it as just another risk management tool. So I'm not going to go over this slide, but I included it so that it would be in the handout for anyone attending who doesn't really know what covered calls and cash secured puts are. That's a little bit of an explanation and an example. And then I probably won't go over this one right here either, since we're going to maybe talk about them on the spreadsheet. And then the next two slides are really the same. What is a cash secured put with an example, and then the criteria that I look for when selling a cash secured put. On this last slide, I'm just letting you know that I've tried to color code the column headers on the Excel sheets that I'm about to start sharing. If it's yellow, that means I have to manually input the information. If it's green, that means I'm pulling the data in from MarketXLS. And then the blue column headers represent calculated fields. Some of them use MarketXLS data and some do not. So I'm going to end the slideshow and then share my spreadsheet with you. And I'm going to pause and see if everybody, maybe ask if everyone can see the spreadsheet okay. You guys can tell me. Ankur, can you see? Okay.
If you can see this spreadsheet fine, can you put in there a message? Okay, perfect. Yeah, Katharine, it's all good. Yeah.
Okay.
It's a bit fizzy, but I guess for fizziness, if you could increase the size, not Katharine you, but if you are viewing it on your machine, yeah, maybe Katharine, you may want to make it just 10% bigger, just to make it, zoom it, but yeah, perfect. I think that should be good enough. Yeah, perfect.
Okay. All right, so I'm going to end up showing you 3 spreadsheets, and it's my understanding that you'll get this exact spreadsheet emailed to you after the presentation as a gift. Hopefully, you'll find it useful. But one thing about MarketXLS is it'll do just about anything you want it to do. So this is just what I've asked it to do, because it supports how I think about investing, but yours may look completely different, may bring in different bits of information. It's very flexible. Okay, so the yellow fields, I have, I'm getting some feedback. Okay, I think that's better, thank you. The yellow fields are the information that I have entered in about my portfolio. So, for example, I bought some stock called AINV, and it's in my IRA. This is what I paid. This is when I bought it. And then the current price is this. So you can see I've lost some money on these shares. I have 300 shares, and they pay a dividend 4 times a year. And so now I'm pretty obsessed with dividends. So I want to understand how much that investment is going to bring to me in dividends every year. To get that information, I brought in from MarketXLS the annual dividend per share and then multiply that by 300 shares. And then this is a calculated column, then using those two fields. And then the yield on cost is basically this divided by my acquisition cost, or by my cost basis. And then I have the market value. So again, you can say I've lost a little bit of money on this stock so far. I've brought in the sector. This is just some historical information from past years' spreadsheets. So I can get a feel for, like, in my life of owning AINV, I've collected $1,100 in dividends from them. So from that perspective, my $600 loss is less horrible. So that's kind of the preliminary. Columns A through P are just me and thinking about dividends and being able to look at all of my stocks in one place, even though they're coming from 3 different accounts. I really like being able to look at them all at once. So the next few columns are what I would call valuation criteria. I would like to know, like, is AINV super cheap right now, in which case I might want to buy more shares, or is it super expensive right now, in which case I may want to take advantage of the high price and sell a few shares or sell all of it even. So I have a few different valuation criteria. I have learned that using only one is not very useful. You need to have a few different ones. And so these 4 columns right here, the 52-week low and high, I pull in from MarketXLS. And then I have a little bit of a calculated logic statement, very simple because I can't do complicated logic statements. This is basically saying if the current share price is less than 25% of the distance between the 52-week low and high, then I want this to light up and say buy. Otherwise, it can say no. You can see that, and this 25% value that I use is completely arbitrary. It's just what I selected to represent a good place to buy more shares as one of the criteria that I might look at. With the market very high right now, there's not too many lighting up to say buy, but maybe a couple. Similarly, over here, I'm looking where the current share price is greater than 90% of the distance between the low and the high. And this may light up if it is and tell me to consider selling some shares. And I'm not necessarily going to sell these shares, but at least it calls it to my attention to maybe look at trimming some, that kind of thing. My favorite, and I don't know if this is really a valuation criteria, but I kind of look at it as a clue on when to buy and sell. I like to buy when the RSI is like under 40 or under 45. And I like to sell when it's over 70, when it's at the overbought level. And so if I see 2 things aligning, like here on Albemarle shares, this is greater than 90% of the distance between the 52-week low and high, and the RSI is clearly in overbought territory, then that's 2 things telling me maybe it's time to sell those shares. And honestly, I would love to sell these shares, but I've got them covered with a call, and I can't do that right now. Another kind of valuation criteria that I use is these 4 columns right here. I bring in the current PE and then the 5-year low and high PE, and then this actually should be a calculated field. Sorry about that. I'm going to fix it. I bring in the where it is in that range, and I'll be honest, this is only of small value to me, that these PE ranges, they just vary so much, and I pay a little bit of attention to them, but not a whole lot. You may notice this one here, MarketXLS is not pulling in any numeric values, and that's because these are preferred shares, and they work a little bit differently than the common stock shares. So I think that's the reason for that right there. In addition to the valuation criteria that I like to just keep on my radar, I have a couple of quality criteria here. Debt to equity. I love when a company doesn't have a lot of debt. So these that are like maybe Verizon with its 2.43, it's basically saying it has 2.43 times more debt than it does equity, I believe is how that works. So that might get my attention to kind of keep an eye on that. Occidental Petroleum is in even worse shape. That's another story in and of itself, that one. And then another quality criteria, which is really related to dividend safety, is the dividend payout ratio. And this is basically, this is the dividend, the annual dividend per share divided by the earnings per share. So if somebody is paying out 195% of their earnings in the form of dividends, well, you have to at least ask yourself, is that a sustainable situation? Here, Atlantica Yield is paying out 536% of their earnings. Now, in reality, you would also be interested in the dividend payout ratio related to free cash flow, as well as this one, which is related to earnings. So there's more to this story maybe than what appears here, but hopefully you get the idea. If you had other quality or valuation or any other kind of criteria that you wanted to bring in, you can see that it's fairly easy to get the information. If I wanted, for example, I can't think of one right now, but let me just show you how the relative strength index is done. I just type equal and start typing relative strength index. And then I enter the ticker or the cell with the ticker in parentheses, and it brings it right in. And then Excel just drops them all down real quick. And so I personally like to look at them with fewer decimal points. And so over here, I've gone in and reformatted the cells to only show me two places past the decimal. But I just wanted to show you how easy it is to bring in that data from MarketXLS. Okay. Should I pause and see if there's any questions about this sheet before moving on to the other one?
Hi, Katharine. Yes, there is one question about the time frame for your RSI. So if you could tell me about, tell the audience about the time frame.
This is a 14-day RSI, which is what I prefer to use.
And it's a daily time frame or a monthly time frame?
Ankur, you tell me. What does that mean?
Oh, sorry, my apologies. Yeah, 14-day time frame. Yeah, okay. Yeah.
That's my.
There is one more question, which is, do you use MarketXLS to determine the stocks in column A? How do you pick stocks in column A?
So it's my understanding that MarketXLS is working on a stock screener. And so I hope to be able to use it in the future for that. Right now, how I pick a stock involves doing quite a bit of reading of articles that people write on the stocks. I love to read one pro and one con article just to try to get a balanced perspective. And then I do sometimes use like the free stock screener on FinViz. And then I also use a stock screener on Stock Rover, which I have a paid subscription to Stock Rover. And that the stock screeners allow me to enter some of those quality and valuation criteria and then get a list of tickers that meet those criteria. And I do think maybe Ankur, I don't know if you want to say anything more about MarketXLS's efforts on that.
Yeah, so we are working on a new stock screener. So to be able to filter out stocks, and it will have a combination of both technical and fundamental indicators. And thank you, Katharine. Katharine is helping us with building out a brand new screener, which I'm sure you like. So yeah,
Okay.
there are a few more questions, Katharine. What is the typical duration for SCs, and what criteria do you use for selection of strike expiration?
Oh, well, we're going to get to the options in just a minute.
Okay, and another one, how much time do you spend in a typical day or week entering data into this spreadsheet?
So I'm retired and I have a good bit of time. And I, as far as just entering data into the spreadsheet, honestly, I only have to enter new data if I buy or sell something. So, maybe just a few minutes per week of that. But in terms of researching and knowing what I want to do and making the trades, that I probably spend a couple of hours a day doing, and it's always during market hours. I live in the U.S., so I trade on the U.S. stock market. So during those hours, two hours a day, most trading days.
Okay, so another question is from Michael. Thank you, Michael. The question is, how do you find out the list of available functions in MarketXLS? So that will be available on the menu. So if you go to MarketXLS menu and you click on search and help, then there is a button which says download function list. And when you would click on that, you should have the list of all the functions.
Right. I won't download it, but hopefully you can see on my screen how easy it was to find this. And I will also say that I know when MarketXLS sells a new subscription, that they do onboarding calls with new customers to help them with some of this. And they are they have office hours where you can join a Zoom call during these hours and ask questions, that kind of thing. So there is a little bit of a learning curve using MarketXLS, but it's a great team in terms of helping you use it well.
Okay, thank you, Katharine. Couple of more quick questions, then we go to option side of things, because I see there are many questions about options. So one is, do you use any hedging to protect your portfolio?
I do not hedge, other than, I think of diversification as being one way to hedge, and position size. If I'm not too sure about something, I'm not going to put up as much money against the stock. If I have a high conviction, then my position size will be larger.
Okay, thank you. And one more quick question before we move on to the next topic. How long did it take you to learn this and become profitable?
So I have totally immersed myself in the stock market for 5 years. 3 of those years were while I was also working, and then 2 years have been while retired. So I've spent a lot of time. I think though, that I started from zero, and I don't know that I went about learning the fastest and best way. I made mistakes, and then figured out, oh, well, I don't want to do that again. So I've learned that I'm not a great stock picker, but I am a good income stream creator. And so once I figured that out about myself, and learning how to invest really is finding out a lot of information about yourself, then I know where to focus. I know what my strengths are and where to focus. But I don't think anybody's going to get started and not experience a bit of pain. That's just part of it.
Okay.
So
Perfect.
moving on to options.
Yeah, that's perfect. Thank you very much, Katharine. And I do see there are some questions on the chat which are related to MarketXLS functionalities. So what we'll do is we'll email each one of you the answers to your questions if if it doesn't tie up to what Katharine is doing right now, but we have them recorded and we'll email back to you. Please go on, Katharine.
Okay, thank you. I've changed my screen. I'm showing you the tab called Options Calls. And this is where I'm just showing you a few of my covered call positions. And I'm not going to spend too much time on this spreadsheet, but just a little. Honestly, when I sell a covered call, I don't spend much time thinking about it. But I do. It's my intention to set strike prices that, of course, are above my cost and also above the current strike price or the current share price. And so I'm looking to go anywhere from 5 to 20% above the current share price. If I want to exit the position, I may only go 5% up. If I want to hold on to the shares, then I want a bigger buffer, and I'll do a 20%, what I call the margin of safety. If the call starts getting out of whack, so let me try to explain this column S right here, where you see I'm in danger on 4 of these calls. This is basically where the current share price has exceeded the strike price. And this first one is just horrifying. This is Albemarle. It's a lithium miner, and they're involved in electric vehicles, which use lithium in their batteries. And I bought these shares at $70. And I thought, well, I'm smart. I think this is going to go up. So I'll set this strike price at $105. I got a nice premium from it. And of course, that was a long time ago that I opened this call position, because the price keeps going up and up and up. And honestly, to get to this strike price, I'm rolling it up like $5 every few months, to where now my expiry date is way out into the future. My strike is 105 and the current price is 234. So I'm in danger because, I'm in a position where I might have to sell it for half of what it would be worth if I did not have this covered call on it. I would still make profit, but, this is sad, obviously. And what I will do with this is, when it gets a little bit closer to 2023, if I'm still alive at that point, I will, be looking for opportunities to roll this up to 110 or 120, but only if I can do it at a little bit of a net profit on the roll. I don't really like to lose money on the roll. At that point, I'd honestly just as soon let the shares be called away. And if the shares are called away, I'll end up with $10,500 in cash that I can do something else with, and just, have learned this horrible, horrible lesson. But so we'll see. The other thing I could do is I could pay $11,940 to buy back this call, but that is not going to happen. So anyway, that's why some of these light up with danger. And when the market is up, like it has been, more covered calls, more stocks go up in price over my strike price, and we'll say danger here. There's not much I'm going to do about these because they're so far out. This one, maybe I can take a look in a couple of months on this one that expires in October. So really that's about all I have to say about covered calls. They're kind of happily so boring to me, and I don't spend a lot of time thinking about them. But are there any questions about the covered calls?
How do you pick DTE?
Okay, so so these dates often are representing where I've rolled them and rolled them and rolled them. But on some that are, like this is one that I sold not all that long ago, back in June. And I'm just looking for a sweet spot between raising the strike price high enough that I'm okay with the shares being called away, if that happens, and getting a decent premium. I like to get an annualized profit on a call. If I can hit 10%, I'm pretty happy. This one is unusually excellent, and I think I just happened to be looking at Siri calls on a good day, because I don't think you could get that for a $10 August call now, for sure. I don't know if that answers your questions. Maybe I should say that I typically look 30 to 60 days out. But if I just want to sell a call and not think about it for a while, I might sell one a year out at some really big strike price, and then I don't have to think about it for a while. And with dividend stocks, you also have to consider the ex-dividend date, because your shares could get called away before expiry date if somebody wants to grab the dividend, and if the things are in danger right now, if that makes any sense. Any other questions?
Yeah, so there's one from John, one from Ken. So I'll take John's question first. Do you follow the resulting cost basis after each adjustment?
It's not shown on this spreadsheet, but yes, I do. So this one here, actually, I never got a single premium that is for $706. I think this is really maybe 3 calls. And so I kind of roll all the net premium into one number for all 3 calls. And this is just my way of doing it. In reality, I received a premium, and then when you roll it, you buy back the old one and sell a new one. So maybe I received 100 and then had to buy it back for 200, but instantly sold another one for 300. And so I keep track of those individual transactions separately, but what I'm showing you here is kind of the summary of all the premiums received as I've been rolling this one along.
Okay. Ken has a question. How do you deal with early assignment risk for your short calls?
I used to cry, and this morning I had one, and I haven't had time to cry. I may do that later, but that's just one of the risks of selling covered calls. I mean, you monitor them and you try to scoot them out of the way. But this morning I had one that doesn't expire until January of 2022 that got called away. And the reason my shares got called away is because the ex-dividend date is tomorrow. So that person wanted to own my shares so that they get the dividend. That one was, in danger as well. And, it's not as if I didn't make some money. I made the money, and you just have to learn to be happy with the profit that you did make. And remember that on the day you sold this call, it seemed like a really good idea. And of course, sometimes that holds true for the life of the call, and sometimes it changes.
Okay, Katharine, another quick question from Bernard. Katharine, would you ever, rather than roll an ITM call, let it assign and sell a lower strike put at a decent premium? If so, what thought or criteria?
Yes, yes, sometimes I sell calls for the specific purpose of exiting my position in the shares. But then sometimes, like this morning with my Lilly stock, you know, I have some cash now that from that, and I probably will use that cash to sell a put. It won't be on Lilly though, because Lilly is overpriced right now, and I don't like to sell puts on overpriced stocks. So I'll have to find something else that meets my put criteria, which we'll talk about on the next spreadsheet.
Okay, how do you track it? It's a question from Jason. How do you track trades that you roll?
Well, I have a more elaborate version of this spreadsheet, and I don't do it on a transactional basis. I do the thing where I roll my premiums into this one total premium. But in reality, I have, you know, a plus, a minus, a plus, a minus, a plus, a minus as I go along. I just make sure that I always have a net positive premium. Otherwise, I would let the shares go. But I struggled with that question, Jason, on how to track it. And I'm not showing you exactly what I do, but kind of hinting at it here. Maybe I can try to send my more detailed spreadsheet out. I don't know. Maybe Ankur would send that to you if I prepare that for him. What do you think?
Yeah.
Okay.
I'll take one more quick one. Do you buy leaps and sell calls against them?
No, I don't hardly even know what a leap is, to be honest. I know it's long expiration something, but I don't. I keep it really simple because, well, personally, I don't think options are simple, but with options, I keep them as simple as I'm able to do. And then I just take, roll with the punches, basically.
Right. And Tom says, how do you decide the underlying stock is losing you more than the option premiums you are receiving?
Well, that's kind of what this danger is over here, because this gain or loss, does that let's see, I'm using, so this gain or loss that's being calculated is using the sales price if assigned, which is basically my strike price plus the premium that I've received. So if these shares get called away at 105, it's kind of like I'm really getting 112 for them. But yeah, this is definitely a bad situation, no doubt about it. I don't know if that answered your question or not.
Yep, we will compile these questions and then we will send it out as well, individual emails. I'll take one more. I'm conscious of time, and it's from Shantanu. Do you check delta on the call options that you sold in order to check whether you are in danger?
I check, I could do that, and that's a great idea. I check the delta when I sell them because I just sort of know where my sweet spot for deltas is on call selling, and it's between 0.15 and 0.25. But yeah, checking the current delta is a great idea. I may incorporate that.
Okay, perfect. Yep, I think that's it for the questions. Of course, we are taking notes of them. So maybe you want to continue, Katharine?
Okay. I've just changed to where I'm sharing the put spreadsheet, and this is my favorite thing. This is what brings me the greatest joy selling puts, mainly because of that number right there, the 25.41% annualized return. So I really like these a lot. So with puts, I have a similar kind of a situation where I look to see if they're in danger or not based on, is the strike price, in this case, is it greater than the current share price? And so I'm in a bit of trouble with SunPower here. I have until September for it to, figure out what it wants to do. SunPower is a solar energy stock, and it's super volatile. The share price changes like 5 or 10% every day, it seems like. So there's no telling what it will do between now and September 17th. But, this just lets me keep an eye on it. Currently, if I wanted to buy this back, I'd have to pay, around $500 to buy back the contract. And for some people, maybe that would be okay. You'd lose this difference between your $366 premium and your $500 paid to buy back the contract. So you'd lose $134. I just don't like to do that. I want all of my losses to be on paper and not in my bank account. So I would never buy this back right now and lose that $134. I would rather, honestly, these shares be assigned to me in September, and then I can turn around and start selling calls on them. But I doubt if I'll have to worry about it because the price just goes crazy every single day. So there may be a great opportunity to buy it back between now and September. And a great opportunity I would define as a whole lot less than $366. I do want to show you two things that make me super happy. And this I just figured out maybe just a couple of months ago. And since I've been using it, it saves me a lot of time. And it also lets me, I think it's increased my put income by about 10%. And that's finding the good opportunities to buy back the put. So the way I've set it up is, let's see, try to find one that's easy math if I have one. This little one, VFF, I have $800 securing that tiny little put, and I received $67 on the premium. So, it's 101 days to expiration. So that turns out I'm making basically 66 cents per day through the life of this contract. Well, and I don't know exactly how far into the contract. Oh, I'm 64% of the way into the contract, but I've made 78% of the profit. And this number is based on, the last of buying it back at the last price. So I'm ahead of the schedule there. And so maybe this is a good opportunity to buy it back for 15 when I had received 67. But I have this little column to show me how much it costs to buy back $1 of my own money, basically. And so the cheapest one is this plug stock. I can free up $2,250 in cash by spending about $10 to buy that back against an $85 premium. So if I need cash or if I have another opportunity, where I could use this money for something I think is even better, then this quickly tells me which put to buy back. I tend to stay 100% invested with either the puts or the stocks. And so when I need money, I often do need to buy something back, and I do that with the puts. The other thing that I've recently discovered that I really like is, let's look at this. I think this is Grow Generation. This stock has a $35 strike, and the current price is getting dangerously close to that, and it expires pretty quick in August. So I might be interested in maybe in a day or two rolling this one. If it goes a little bit lower, I'm going to keep an eye on it. And so if I at the point where I want to look at options to roll it, I can definitely look in my broker software, that kind of thing. But this is kind of a cool thing that I can do on MarketXLS. I can just highlight the ticker and go up here to Utilities, Options Scanner. And Ankur, can you see the option scanner?
Yeah.
Okay. So you see that quickly it's bringing in all the options on GRWG ticker. And I only want to see puts. I don't want to see these expiries because my original one doesn't expire till August 20th. And then let's see, that put was $35. So I would want my strike price to be less than 35, less than or equal to 35. So now this gives me, and if I wanted to remove the zero contracts, I could do that, but I usually just leave them open. And then I sort by the biggest premium. So here are some nice opportunities to roll. I may not want to roll so far out. Maybe I'd be more interested in something like this, where I can sell a put for $377. This is the same strike, so I might really rather do something like this, where I can go down a little bit with the strike and still get $350 in January. So, just you can sort different ways and try to figure out which one is the best. And you can do all that quite quickly. And the thing is, I want to, I'm going to have to pay on this one, excuse me, I would have to probably pay about $170 to buy it back. And so I would want this premium to be greater than that. So that would be another criteria to have. On puts, regarding deltas, I'm looking for the negative 0.15 through negative 0.3. I'm looking for a margin of safety between 5 and 20%. Depending on whether I really want to own the shares, how much I want to own them. I do growth stocks, probably as much as dividend stocks here. I try to only own dividend stocks, but I may own a growth stock for a short period of time if they get assigned on a put. But then I would just turn around and try to sell them on a call. And that, I think, is all that I wanted to say about it. I did want to show you, I've already shown you how easy it is to add a new function here. So I did that on the other sheet. So Ankur, do we have any more questions?
Yeah, we do have a few questions, and I'm conscious of time. We just have 5 minutes left. So if we are not able to answer or if Katharine is not able to answer these questions right now, we will follow up with you individually and we will answer these questions. But I'll take one here real quick. What is your average moneyness on your options? I.e., how far OTM do you go? And also, what's your average time to expiry when you enter an options trade?
So for puts, my average moneyness, and I've never actually calculated that, but I would say it is average 15%, maybe 10 to 15%, but it varies based on what the stock is, how volatile it is, and all of those kinds of things. And the days to expiry, it tends to be the 30 to 60 days is where I start. And then if I have to roll, that may end up being further into the future.
Okay, perfect. So, Katharine, thank you very much. I think this was a fantastic presentation. I see Kenneth also loved it, and I think this was very good. And my apologies, we won't have time to go over all the questions now, but we'll definitely follow up. This webinar will also be available as a recording to you, and we will send you the template which Katharine is showing right now, and also the handout will be available to you as well on your email. And if you have MarketXLS, I thank you very much for using it. We will be doing more such presentations, and the idea is to learn together and to see if we can get some ideas to improve our investment research workflow. Meanwhile, if you are not using MarketXLS already, we have created a special coupon code for this webinar. It is called webinar01. So if you were to go to marketxls.com/pricing, you should be able to get your subscription. And I once again thank you, all of you, for joining in. And we will come back to you with another topic, uh, with uh, with another analysis video, which will help all of us. So thank you very much. Really appreciate that, and we'll catch you in the next webinar. Okay.
Thanks, everyone.
Thank you. Thank you.